how to invest in the stock market. Investing can be defined as the act of putting money or capital towards an endeavor with the intent of making a profit or gaining another source of additional income. In other words, it is a way to make your money work for you as you live out your life. Moreover, when done correctly, it can serve as an additional source of income. Unlike being a consumer, which is also a means to a happier ending, being an investor allows you to create opportunities, help other people, raise the economy, earmark money in several vehicles in the hopes of increasing one's wealth. Before you begin your journey as an investor, you must identify the category of investor in which you fall in. Will you invest passively? Will you invest actively? Are you a speculator? Do you consider investing for retirement only? As you set up your brokerage account, most, if not all brokers will ask you a series of questions about your investment goals and risk tolerance in order to better serve you and to provide you with the necessary tools and services in order to help you safely reach your destination. In most cases, investors tend to be very hands-on with the management of their assets as their wealth increases. In other cases, most prefer to put money in the market and to once in a while check back on their portfolio to see how well or how bad it has performed over time. Both forms of investments mentioned earlier allow you to invest in stocks, bonds, exchange-traded funds or ETFs, index funds, and mutual funds. Here are 5 steps to follow whenever you are ready to start your journey as an investor in the stock market. Number 1. Know the difference between individual stocks and mutual funds. An individual stock represents a share of a company. In other words, it is a partial ownership into the profits of a company. Mutual funds or exchange-traded funds are vehicles that allow you to purchase small pieces of many different stocks in a single transaction. Whether it be index funds or ETFs, such assets can easily be tracked and are type of mutual funds. Then that track an index. Through individual stocks, you can either purchase a single share or a few shares and see how well they perform over time as a way to get some experience into the market. Through mutual funds, your portfolio is diversified, thus lessening your risks of potential loss. Though building a diversified portfolio out of many individual stocks is possible, it will take a significant amount of time and amount of capital. Therefore, going for mutual funds or exchange-traded funds is a much better alternative. Number 2. Open an investment account. In order to invest in stocks, you will need to open an investment account. For the people who like to be hands-on, opening a brokerage account is the better alternative. For the ones who don't mind getting a little help, opening an account through a robo-advisor is preferable. Both brokers and robo-advisors allow you to open an account with very little to no money. An online brokerage account offers a multitude of services, including the quickest and the least expensive way to buying stocks, funds, and a variety of other investments. With a broker, You can open an individual retirement account or IRA, or you can open a taxable brokerage account if you're already saving adequately for retirement elsewhere. A robo-advisor offers the benefits of stock investing, but doesn't require the user to pick individual investments. Most robo-advisor services provide complete investment management. Though it may sound costly, the management fees charged by a robo-advisor typically cost a fraction of what a human investment manager will charge, around 0.25% of your account balance at the most. Number 3. Set a budget for your investment. The amount of money needed to buy an individual stock depends on the current price of a share. Share prices can range from a few cents to thousands of dollars. If you wish to invest in mutual funds and have a small budget, an exchange-traded fund or ETF may be your best bet. Mutual funds often have minimums of $1,000 or more, but ETFs trade like a stock, meaning you purchase them for a share price, in some cases even less than $100. Furthermore, through mutual funds, you can allocate a large portion of your portfolio towards stock funds only, especially if you are investing for the long run. An example of an ideal portfolio would be as followed: 70% invested towards stock funds, and 20% invested towards bond funds, and 10% invested towards individual stocks. Number 4. Manage your portfolio accordingly. Closely monitoring your portfolio because you hope to see it constantly increasing in value won't do much for you. In fact, it might lead you to anxiety attacks every time the market experiences a correction. If you've invested intelligently, you will only want to revisit your portfolio a few times a year to make sure it's still in line with your investment goals. One thing to always remember is that whenever you are approaching retirement, you should consider moving some of your stock investments over to more conservative fixed income investments. If your portfolio happens to be too dependent in one sector or industry, it is recommended that you consider buying stocks or funds in a different sector to build more diversification. Moreover, you should also consider expanding your reach by buying international stocks. Number 5. Focus on the long-term goal. Though becoming a successful investor might require you to broaden your knowledge about the market and to implement the strategies that best fit your investing style while ensuring great profits, some of the best investors on the planet attribute their success to sticking to the basics. In other words, using mutual funds for a bulk portion of your portfolio while minimally investing in individual stocks only if you believe in the company's potential for the long-term growth. Another tip for the future investors is to not try to time the market and to instead invest consistently. Moreover, you should avoid the habit of compulsively checking the performance of your stocks several times a day, every day, unless you've become a day trader or a swing trader. In conclusion, unlike being a consumer, which is also a means to a happier ending, being an investor allows you to create opportunities, help other people, raise the economy, earn more money in several vehicles in the hopes of increasing one's wealth. Before you begin your journey as an investor, you must identify the category of investor in which you fall in. Will you invest passively, Will you invest actively? Are you a speculator? Do you consider investing for retirement only? As you set up your brokerage account, most, if not all, brokers will ask you a series of questions about your investment goals and risk tolerance in order to better serve you and to provide you with the necessary tools and services in order to help you safely reach your destination. The end. Thank you.